topic of this video is why professional investors are not rational. But before I start, quick bit of context. I spend most of my time inside active capital raises, working with developers who are actually active in the market raising money. So this isn't theory, this isn't planning to raise money. I literally do this every single day. We're talking about raising money for these operators, these developers, all day long, all year round. What I'm about to talk to you about is something that's become pretty evident over the past 15 years of me doing this. And it's one of the most misunderstood parts of capital raising, actually. And it's the main reason why so many technically sound deals still struggle to attract money. And just so you know where I'm coming from, I've raised capital for over 15 years. I've seen small operations become massive on the back of successful capital raises. I've seen large companies consistently raise on successful projects, the real estate world and the rest of the alternative investment market too. So that means real estate development, of course, multifamily deals, single family builds, but also rare earth metals, precious gems, and lots of other hard asset opportunities out there too. I've also seen what happens when incentives break down in this process as well, when structure breaks. And I've lived through some of those consequences where capital has actually been raised without discipline, especially when there's been bad actors involved. My experience throughout all this time has permanently changed how I think about investors and money in general. And I create these videos now to share some of those insights with you now. Getting back on the topic of this video, most developers believe that capital is rational, or better put, most developers believe professional investors are rational. They believe that money moves because the numbers make sense, that returns are competitive, the logic is sound. So when capital doesn't move, they assume something must be wrong with the deal, right? But the reality is professional investors aren't as rational as you think they are. And once you understand that, raising money becomes much clearer. You see, when developers say rational, what they really mean is predictable. They expect that if the risk is priced correctly, returns are competitive, assumptions are reasonable, then the professional investor should respond accordingly and money should just move, right? That makes sense because that's how developers think, that's how engineers think, that's how builders think. But money doesn't behave like an equation. It behaves like a human because it's their money, right? And humans are not rational. They're cautious, they're emotional, they're pattern driven. They have a severe allergy to losing money and they're deeply loss averse. Look, professional investors or capital in general doesn't move towards the best looking deal. What they're actually doing is they're moving far away from perceived danger as possible. And that distinction really matters, more than returns ever will. On one hand, investors are thinking about how to raise money. Of course they are. But equally as important, they're thinking very seriously about how not to lose their money, because losses hurt way more than gains feel good. And that's not my opinion. That's just human behavior in general. This means an investor will literally pass on a great looking deal that just gives them that sense of uncertainty. And you'll see them instead go for something that looks pretty mediocre looking. But the difference is that it feels controlled. Perhaps it feels safe, maybe more stable. But on paper, the better looking deal looks better, right? And most people who are looking in on this decision, the developer themselves especially, because they're so attached to their own deal, of course, or perhaps there are other people out there who have visibility on that deal, who are not actually putting up their own money. They might think that this investor seems irrational. They don't understand why the investors don't choose it. But when you consider the emotional position the potential investor is in, it actually makes perfect sense why they wouldn't move forward. I know a lot of developers get stuck here. The last 15 years, I've seen developers trip up on this pretty straightforward issue, because what I tend to see is that they respond to that hesitation an investor starts to display with more data, more explanations, more spreadsheets, and all that extra logic doesn't actually override the sense of fear or uncertainty that investor has. In this case, it's actually amplifying it. Every additional detail that you provide an investor gives them more places to imagine something going wrong. Seriously, more logic doesn't reduce the perception of risk an investor may associate with your deal. What's actually fixing the problem is something completely different. What you need to be doing is focusing on structure, clarity, and control. So how do you really move money then? Well, it's all about answering those internal questions that investors actually have, right? So the first question is, do I feel safe engaging with this opportunity? Here's what that actually looks like. An investor sees a new opportunity. Before they even look at the numbers, they're asking things like, is this familiar territory for me? Is this a space I've invested in before? Is this something I understand at a basic level? For example, a multifamily investor will at least feel open to another multifamily deal, right? They'll review it. A land development investor will feel safer engaging with another land development opportunity. But if you show that same investor a new complex structure, a brand new asset class, something that may perhaps feel a little bit exotic, Bitcoin maybe, their guard's immediately going to go up, right? There's nothing necessarily wrong with the new option, but mentally, they're already in defense mode. And if that opportunity doesn't really feel safe to engage engage with on the first instance, it's never really going to get a fair look, is it? So the second question that you've got to think about as well is, do I trust the structure of this opportunity and the people behind it? Once an investor feels comfortable with engaging at a surface level, their focus then shifts and they're now asking, is this set up properly? Who's actually in control here? Do these people know what they're doing? And what happens if things don't go to plan? For example, they'll look at how the deal is structured. Is there a clear sponsor? Is there a clear decision-making authority? Is there a clear use of funds? They'll pay attention to your tonality too as an operator. Is the operator calm? Are they measured? Or are they defensive and over-explaining a lot? They'll notice whether questions are answered cleanly and confidently or with hesitation and workaround language. This is where trust is either built or quietly lost. So if the structure or the people feel shaky, the deal stalls, even if returns look great. The third question is, does this align with patterns I've seen before? It's only after the first 2 points are satisfied that this question actually comes into play. Now, the investor is subconsciously asking, have I seen something like this before? How did those situations usually end? What does this remind me of? For example, if they've invested in 3 or 4 similar deals that were structured cleanly, they ran on time and communicated well, that feels normal. The outcome feels somewhat predictable even. But if the structure reminds them of a deal that dragged on, missed timelines, perhaps went quiet during construction, then alarm bells start going off, right? Nothing has to be wrong necessarily, the pattern just doesn't feel right. And when the pattern doesn't feel right, the investor doesn't necessarily argue with you, they don't, renegotiate, they just step back. It's only after all that do the numbers even matter. That's why most investors don't outright reject deals, they just disqualify them. Disqualifying them quietly, you won't even know. By the time returns are being debated, the real decision's already been made. Most developers are working in reverse with this, right? And when I say most developers are working in reverse, this is what I mean. They start at the third question first and then work backwards. They lead with the numbers. So the first thing an investor sees is the ROI, the IRR, the projected returns, the upside scenarios, the best case outcomes. From a developer's perspective, that feels logical. I mean, you have to have it in your ad, right? That's how you're going to get attention. But the developer's thinking, hey, look how good this deal is. Look how strong the math is. Look how attractive it is. But from the investor's perspective, they're seeing something very different happen. They haven't decided whether they feel safe engaging with this yet. So instead of excitement, the numbers start triggering a sense of suspicion. They're thinking, why are they leading with this? What's being sold here? Why am I supposed to be impressed with this? Then developers move to the second step, which is the structure and the people behind the business. But now the problem is the investor has questions. So now the conversation becomes reactive. The investor's asking, who's in charge, right? What happens if timelines slip? How protected am I with this whole thing? And the developer or rep starts explaining, they start pulling up more slides, they start adding more context, more documents, they try and reassure consistently. But that reassurance after the doubt has already set in never really feels as strong as confidence before doubt, right? And at this point, the investor is already super cautious. They're listening, but they're listening defensively. And finally, almost as an afterthought, developers try to establish, that safety and that familiarity. And they start saying things like, this is actually very similar to XYZ. This is, stuff we've been doing for decades now. We've done deals like this before. This is pretty standard practice in this space. But by then it's too late because investors have already, felt sold to. They've noticed that sense of uncertainty. They're pattern matching already. And they've done it against, past deals that went wrong. That's the wrong pattern matching you want. Nothing has to be objectively bad about your deal. The order alone that you presented it created the friction. When you led with numbers, you forced the investor to decide before they felt safe. When you explain the structure after the hesitation, it feels like super defensive. And when you establish familiarity as the last thing that you're doing, it feels like you're backpedaling. So the investor doesn't say no, they just say, let me think about it, right? Which usually means I don't feel comfortable enough yet. And this is why developers get, initially a lot of interest, they get a lot of questions, lots of great deal feedback perhaps, but very few commitments in the end. And that's not necessarily them being rejected as such. It's really just being quietly filtered out by the order of their own presentation with those investors. And then they wonder why capital raising feels like such a struggle. Experienced investors don't necessarily analyze deals deeply at first. And this is really from my experience. What they're actually doing is they're just pattern matching. Think about your own life in terms of how you look for things and sort things and sift through things. Usually it's not because of this overwhelming sense of due diligence that you're about to perform. What you're actually doing is just pattern matching. Seriously, through all the direct sales that I've done with investors myself, through all the coaching that I've done with my own sales teams who are actively raising capital every day, I realize that what people are really asking is, have I seen this before? Right? They're looking for that pattern. How did it end the last time? What does this remind me of? And if the pattern feels wrong, the deal just dies. It dies quietly too. There's no argument, there's no debate, there's no repitch or opportunity for a repitch. It's just nothing. And if you've ever sold investments or raised capital before, you know exactly what I'm talking about. So the most dangerous assumption developers make is this: if the deal feels feels logical, investors will just come around. And from what I've really learned over time is that they won't. Investors don't get convinced like that. It either feels safe or it doesn't. And once an investor mentally categorizes a deal as uncertain, it's really, really hard to reverse that impression. So remember, investors aren't as rational as you think they are. They're protective. They're not necessarily chasing upside all the time or as aggressively as you may think. What they're doing is they're really just trying to avoid downside. So what do you do instead? Well, when you structure your opportunity and you build out your marketing collateral, you build out your project collateral, but you do it all through the lens of how investors actually decide, meaning first, do they feel safe engaging with this type of opportunity? Second, do they trust the structure and the people behind it, and only then do the numbers start making sense? Then everything changes. You stop trying to convince, you stop having to over-explain, you stop having to chase commitments, because the investor is being guided through the decision in the same order their brain already uses. Your job isn't to prove the deal is good. Your job is to remove those reasons for hesitation. And that distinction really matters, because proving a deal creates debate. Removing hesitation creates that movement that you're looking for. So what does that mean in practical terms for you? Well, it means 4 things. And the first thing is clear positioning. So someone immediately understands what this is, where it sits in their portfolio, and why they're even seeing it in the first place. For example, an investor shouldn't have to guess whether this is income focused or if it's a value add opportunity, if it's a development risk, if there's an opportunistic upside. They shouldn't be wondering if this is supposed to replace their bonds, if this is going to be a growth capital, or if this is going to be a more speculative investment. If they're doing that mental sorting themselves, you've already created that sense of friction that you're not looking for. You see, clear positioning removes that pressure. The investor instantly knows what bucket this is meant to go in their portfolio and whether it even belongs in their world. The second thing is disciplined structure. So the risk is really handled by how the deal has been set up in the first place, not by you having to talk around it on a sales call, for instance. For example, if timelines slip, there's already a process in place. If costs move, there's already a buffer. If decisions need to be made, it's perfectly clear who makes them, how they're made, and in whose interest, right? So you're not necessarily verbally reassuring an investor, but you're letting the structure do the talking for you. The structure is doing the reassurance for you. That removes the pressure in the conversation, because the investor is now not asking what happens if this goes wrong. They can already see the answer. Okay, number 3 is about controlling the narrative, so investors evaluate the opportunity in the order that you intend, instead of jumping ahead and misreading something and then just going quiet on you, right? We all hate that. And this is really important when it comes to presenting your ads out there. Of course, on your ads, you're going to be showing the returns. That's normal. That's usually what gets attention, right? It's going to be in the ad. There's going to be subject lines and emails. It's going to be headliners everywhere. That's what garners the attention initially. But what happens next really, really matters, because you don't want to lose control. And without control, here's what the investor experiences. They're going to see that high return, the ROI, the IRR, but they haven't really understood the risk yet. So the return doesn't really create the excitement you're looking for. What's going to do is start creating the suspicion. They're going to start thinking, why is it that high? What am I missing? Where's the catch? That's pressure. That's going to create a lot of sales pressure for you. And once that pressure shows up, everything else gets filtered out through a ton of doubt. With a controlled narrative, on the other hand, the experience is completely different. Yes, they're going to see the returns. Of course they are. But immediately after, they're guided to understand what kind of risk this actually is, how this is structured and contained, and especially designed to fit their portfolio because they're the right target market for this ad, and who's in control if something goes wrong, right? So by the time they're asked to evaluate the upside, they're doing it with the context that you put in there, right? Not skepticism. Returns don't float on their own. They need to be framed after the risk has been understood, not before. That's the difference between returns creating curiosity and returns creating hesitation. And finally, number 4, and this is about creating that sense of visible momentum so it doesn't feel like they're the first person looking into this, or that nothing's going to happen unless they say yes. For example, if they feel that conversations are already happening, if they feel that allegations are constantly being discussed and money's being moved, this opportunity is going to exist with or without them. And not because of any kind of sales tactics or sales pressure, but because it's actually moving. You've really given them that sense of visible momentum. It seriously helps remove that quiet internal fear. The one that sounds like, I don't want to be the first. I don't want to be the only one. I don't want to be in too early and be wrong with this whole opportunity. You see, momentum removes that sense of isolation in this whole process. And isolation is one of the biggest hidden blockers in capital raising. When you have clear positioning, a disciplined structure, a controlled narrative, and that clear sense of visible momentum, investors don't necessarily need to be persuaded. They don't really need to be pushed. They don't necessarily need to be convinced. They just deploy capital because it feels like the natural next step. It's not emotionally risky. It's not socially risky. It's not structurally risky. It just feels logical after it feels safe. Okay, if this changed how you think about capital raising in any way, I'm building a small platform for developers who want to actually fix these issues before going back out to the market. It's just a wait list right now, but if you want to be notified when that actually opens up, the link is in the description below. If not, no worries. This framework alone should have already perhaps changed your approach. So remember, in a nutshell, professional investors aren't rational. They're cautious. And if you build your cap raise for caution first, raising money will be way, way easier.